Welcome back to Market Minutes, everybody. Today I'm joined by Ryan Goren, Senior Associate at Peakhill Equity Partners. We're going to be taking a look at U.S. acquisition strategy and what Peakhill Capital is looking at south of the border. Ryan, great to have you here today.
Thanks for having me, Chaim.
Ryan, I've noticed there's been a lot of noise around U.S. multifamily over the last number of years. We saw interest rates creep up over COVID. We saw a slowdown in acquisitions, certainly a slowdown in construction. Can you break down what you're seeing as to why Peakhill Equity is excited about the U.S. multifamily market?
Sure. Well, let's start with the salient points. Number one, there is still a long-term shortage of housing in the U.S. There's a shortage of 4.5 million housing units. Number two, for every 9 renters, there's 1 vacant unit. So there's a clear shortage. The fundamentals remain strong. Compounding that is we're going into a window right now where we're coming out of a wave of supply that has happened over the last 3 years, where for the first time next year in 2026, it's expected that the demand is actually going to match the supply. This is being driven by, over the last few years, construction costs have gone up, interest rates were high. This all led to a slowdown in new development. That will bode well for us as we look at U.S. multifamily over the next 3 years.
Because construction costs have gone up, we've seen less new units coming online, and people have the inability to now execute buying new homes, downsize or right-size their living situation, depending on trying to get in or out of the housing market. Given that we're seeing this opportunity to buy now, what specific opportunities are we looking at?
So although we still think development opportunities are attractive, we're starting to see a lot more appeal in doing acquisition. So for example, we're looking at some value add acquisitions where we're buying properties with the ability to improve operations, drive revenue, and ultimately drive returns for our investors. Also, we're starting to see some stress come through in the market. So the delinquency rates are now ticked up in the US above 1%, which is something we're keeping our eye on. And we're seeing this in real life, where we've recently been presented with an opportunity in the Dallas market, which is a market we like for many reasons, where we can buy a building that's cash flowing for below replacement cost. And in this case, there's a seller that has to sell the property at their lender's basis, which is the amount that they owe for their loan. So we can get into this investment and offer terrific risk reward profile for our investors.
That's interesting. So a lot of the opportunity we're seeing is a result of both undersupply in the market and potentially some poor financial management or poor, people were buying at the peak of the market, interest rates crept up, and then everybody found themselves in a cash crunch, and we're able to now see opportunities where we could pick up the pieces of that. So you mentioned Dallas as a specific opportunity. What other geographic regions are we focused on?
Yes. So I'll just say at a high level, we really like the Sunbelt markets for a lot of reasons. One, they tend to have lower government intervention. Two, they tend to be high population growth states. Three, they tend to have good employment prospects where they're high paying jobs, good incomes, which are all things we take into account. We're looking at the ability to drive value in the properties that we acquire. Markets like Dallas, Charlotte, Arizona. So these are all markets that we really target because they have these attributes.
So looking at acquisitions, Sunbelt states, Q4 should be pretty exciting for you. Whether it be policy changes, specific markets, project types, where do you see yourself spending most of your time this coming quarter?
So we're going to continue to look for these compelling, attractive acquisition opportunities where we can buy at very good prices. Cap rates have peaked. They peaked in mid-2024. They're starting to come down now in 2025. So we think this sets up well for valuations going forward. But we're going to keep our eye on interest rates, and ultimately the 10-year Treasury yield drives those interest rates. So we've got our eye on that. Right now it's at around 4%, but we will keep our eye on it to make sure that it lines up with our valuation criteria.
Thanks for all the insight into U.S. multifamily, Ryan. Good luck in Q4. Can't wait to see what the team puts together.
Thanks for having me, Chaim. Appreciate it.